when you're measuring the difference between wholesaling and wholesaling, one of them is risk. The risk in the title, the risk on the kind of money that you have to put in. I bought a duplex specifically. I was living in one, renting the other one, and then I went and refinanced, and I took $200,000 out to get into my next project. And just because I buy it right. So what is important is that you always buy it at a discount. Also, when we look at these two strategies non-passively, the side of the wholesaling, I see it a little bit more risky because you have to put more capital and you might need to fund the purchase and really find a property that you have to buy it at discount no matter what. Because if you don't do it that way, when you refinance and try to take the money out, the leverage on the loan won't allow you to do that.
If you can't make money in every market, you shouldn't be in real estate at all. But I have more faith in my real estate than I do in my stocks. And we all know that.
I'm really excited about this particular Alternative Investing Mastery session. And why? Because it's about residential real estate. We don't talk about that often, but it was a stepping stone for me. And it has been for a lot of the investors that follow us. I was a high-tech automation robotics engineer and stepped into single-family investing. Had a rough go at it my first time and did a little bit better after that. But let's see if you can skip some of those missteps that I made and learn from some of these expert panelists today as we seek mastery in the art of alternative investing. If you're new to this, this is Passive Investing Mastery's alternative strategy educational webinar series. We educate in a lot of different ways. What is residential real estate investing? And not the encyclopedic version. We got to keep these and then open it up to the panel for other comments.
Sure. Well, for me, it is my cash and wealth building machine. Think of this. Residential real estate is all about buying properties where people live, right? Residential real estate. Residences. That could be manufactured homes, single family condos, townhouses, apartment buildings. But the goal here is earning a return on your investment. That's why we invest. Rental income, appreciation, and the tax benefits is what we're after. And some people, that is more on the long-term side, but some people will flip houses like myself on the short-term gains, while others play that long-term and build a rental portfolio for that steady income. So there's a lot of different strategies that come along with residential real estate. One of the most spectacular things I can think of residential real estate is that I can never learn it all in a lifetime. So I'm always on the edge. And today we're going to be sharpening iron against iron.
I love that, Sensei. I mean, tapping into what just Sensei said, it's about having that single family home. But one of the things happening during these times is that residential homes, if you think about it, we are in a housing crisis and people cannot afford homes, they cannot rent, which is bringing another opportunity for us as investors, not only to help this family to find different creative ways to build these homes or flip these homes in a way that make it affordable for them. So beyond taxes to beyond cash flow, all of us are looking for that. I see residential too as a way to leverage, especially if you're starting, leverage your wealth, increase that portfolio. And residential investing give you a lot of stability. It helps you learn lessons, as Sensei say, we can learn from each other so much, but starting with residential and scaling from that, you never know, it's always different, but learning residential investing, it's powerful when you know how to, jump in.
But first, what do these things mean? Because people, as Mike and Sensei were talking about, they know what it means to buy something. What does it mean to flip something? And what does it mean when you use the phrase wholetailing? Let's talk about what flip and wholetailing are and how those are different.
Yeah. Okay. So wholesaling, flipping, wholetailing and wholesaling are kind of similar. You're buying a house and you're not doing anything to it, or you're taking control of a house, not doing anything to it, put it back on the market. Wholesaling is basically that. The difference is you actually are taking title, right? So I buy a house from Patrick, I take title. I don't go in and do a renovation to it. Maybe I do something very light, right? Like maybe just some paint or clean out some debris, make it so it's sort of a little bit more photogenic, and then I put it on the market and sell it. That's wholetailing. Wholesaling is where you never really take title, right? You sign a contract, you find an end buyer for that contract, you bring the end buyer to the closing with the seller, they consummate consummate that closing, and you get paid a fee for that transaction kind of in the middle. It's it's a wholesaling fee basically. Flipping is exactly what most people know. After HGTV kind of took over the world back at 15 years ago, now everyone kind of knows, right? They saw all the people doing it. But you buy a house that's in distress, physically in distress usually, and you go in and do work to it, spend money, and then you sell it yourself. You sell it on the market, MLS, or however you're going to do that. But you sell it yourself as a retail sale, and you make the money on that property. And then buy and hold is rentals, right? It's buying houses for the purpose of maybe fixing them a little bit, hopefully fixing them enough that it's a nice house for someone, and then renting it out long term on a month-to-month basis or year-to-year basis, however you're doing it. But so that's sort of like that tax strategy. It's the appreciation. You don't get appreciation really from flipping, and certainly not wholesaling and wholetailing, but you get that appreciation from long-term buy and hold. So that's why it appeals to some folks, who do it that way. And I do it that way. I have those as well.
Yeah. Mm-hmm.
I
right,
think
let's
that's a
hear
great
from-
definition. This is my world here. I noticed in my bio that that's about 5 years old, because this is our 30th year anniversary, and we just broke over 15,000 flips in 2024. So with that, we do a lot of flipping, and then we turn those into rentals. But if we take, at the wholesaling, the fix and flip and the rentals, there's different types of risk factors that come along with that, right? Risk factors is always your name on title, the money that you borrow, the cash out of your pocket, any liabilities of people being on the property. So when you're a wholesaler, you don't really have those risk factors. You're flipping properties without the cash credit and taking title, but you get paid a little bit less. However, your returns are infinite because you really don't have any money into the deal. That's truly not investing. You're really just a dealer at that time, or a broker between two parties. On the invest, fix, and flip side, you got a longer term that's going to take maybe 6-9 months. You invest your money, you invest your time, you put your name on title, you get bigger returns. Those two, wholesaling and fix and flipping, is all about generating cash. You'll never be wealthy by doing those two. Trust me, I know. Wealth comes from the residual side. I'm not going to say passive, because if you own residential real estate, then you're going to put some work into it. There's nothing passive about it. You're still somewhat of an active investor. You may not put the time as if you're doing a fix and flip. You may only put an hour or two at the end of the month into a couple of properties. But to truly call it passive, it's not. It's more of a residual income.
Yeah. Exactly. It's as you both say it, it's residual income. And to leverage on what Sensei was saying, when you're measuring the difference between wholesaling and wholetailing, one of them is risk, the risk in the title, the risk on the kind of money that you have to put in. Also, when we look at these two strategies non-passively, the side of the wholesaling, I see it a little bit more risky, because you have to put more capital, and you might need to fund the purchase and holding costs for these properties. Of course, we're not talking about financing. That's another thing, right? But also, when you're doing wholesaling, normally you can often command a higher price than wholesaling. When in wholesaling, you're selling the paper, and the wholesaling, you're selling the property. And I see it as simple as that. That's a pretty simple difference between those two.
So a lot of conversations here, and I think I resonated with Sensei, but a lot of conversation here about the power of flipping and the power of like wholetailing, right? Wholesaling, because you get a quick, you can get rid of them quick, you can churn and burn fast. And I think the conversation, some questions here about is it active or passive? And I think we answered Dale's questions about what are the differences. But what I found is that it was a lot of work, because I was a full-time automation robotics engineer, but finding properties, getting out there, learning how to market, build a network, and then doing the work to actually get a contractor to make the improvements, and then lining up the ability to then sell it or refi it. I found it was like a ton of work. And I was like, well, wait a minute. Leaning into what Sensei said, I'd be like, I don't need another job. I want something residual. I want some compounded interest. And so that's why I went for what I didn't know at the time, but it was the BRRRR method. Maybe we can talk a little bit about what the BRRRR method is, because in my world, I wanted to put in the work, but I wanted to ride out some appreciation, some debt pay down, and some cash flow. That's why I went for that long-term and hold. Do we want to drill in a little bit about that strategy?
Jennifer, go for it.
I mean, the BRRRR method, I just love it, because you really find a property that you have to buy it at discount, no matter what. because if you don't do it that way, when you refinance and try to take the money out, the leverage on the loan won't allow you to do that. So BRR method not only allows you to take some money out without taxes, right? Because you're not selling the property right away. It's just allow you to tap into financing to go and move to another property, allowing you to build a well portfolio, right? While getting some cash. And it's actually one of my favorite. That's what I did when I started. I bought a duplex specifically. I was living in one, renting the other one. And then I went and refinanced and I took $200,000 out to get into my next project. And just because I buy it right. So what is important is that you always buy it at a discount. What does that mean? That can be an entire conversation, right? Buying a discount. I'm not going to get into the details, but that's how I see BRR method.
And the BRRRR method is buy, renovate, refi, rent,
Yes.
and repeat, right?
Yes.
And that way you essentially get it at a price at which you can improve it. You pull out your capital and then you just rent it and then own it and you got your capital back and then you reinvest it, right? And that's the heart of the BRRRR. Just taking it back one notch. But let's lean in a little further with Mike Sensei. Do you have any comments about that BRRRR method, that long-term hold method?
Well, the BRRRR method is nothing new. It's been around for over 100 years. It's just a new coined term is what it is. And it's really the springboard for most investors to get to the next level. Think about playing Monopoly. When we play Monopoly, do we automatically buy hotels on Park Place or do we buy the little cheap property first, right? We buy the cheap one. We collect some rent. We do some sweat equity to the property. And if we did it right, like Jennifer said, we buy it at a discount and the equity starts to grow through appreciation. That allows us to turn around and either sell the property and kill the asset, move the money over to another property, or we can actually just refinance it, still make that property cash flow like a champ and take that excess equity and then put that to work. Anybody ever read the book Richest Man in Babylon? I mean, they actually talk about this way back thousands of years ago of equity being workers that are lazy sitting in your house. If you got equity in your house, your business, your car, and it's just sitting there, they're just getting lazy is all they're doing, getting weak. So we want to be able to take those workers out of that property, out of that business, and start building upon that.
Yeah, so I created a buy and hold portfolio. I didn't use the BRRRR method. I had a little different strategy. I had a partner who was kind of financing everything, but yeah, the BRRRR method is nothing new. I mean, there is a new little catchy BRRR that people use that, I think somebody on Bigger Pockets kind of originated that, but it is nothing new. And if you're looking for cash, appreciation and pay down of debt and you want to build a portfolio, I totally get it. My brain is still stuck on the active passive because I have a real passionate argument about that when it comes to flipping and wholesaling and things like that. While I don't disagree with what Sensei said, there's another perspective. And I'll just be quick because I think it's important for people to understand. And, there's a panel here for different perspectives, right? So my company did flipping and wholesaling, does flipping and wholesaling. We've been doing it for 10 years. We've been doing 100 deals a year, right? Now, are we building appreciation? Absolutely not. We're not. And so if that's your game, then it's not for you. But when you talk about active or not, I had a portfolio of 25 rentals and I was flipping and wholesaling 100 properties a year. I spent far more time dealing with rental drama and rentals, even though I had a company that was doing the management, but the company still has to come to you with questions and approvals for payments of, contractors and things like that. So what I kind of equate it to, while it is active, right? It's sort of like this. It takes a lot of energy for a rocket ship to get off the ground, right? A lot of fuel, a lot of work, tons of it. And if you stop before you get to orbit, your only knowledge of that is that it takes a lot of energy to get a rocket off the ground and get it into the sky. And then you stop and that's fine. There's a point though where that rocket gets into orbit and it doesn't need all that thruster anymore. It's not going to come back down because it's in space or it's in, outer orbit. And so you can get a flipping company, a wholesaling company to a point where you've got the team, you've got the processes, you're generating leads on a predictable basis, and you're doing enough. You have a team built. Like I'm not, it's not hyperbole. It's not a selling point. It's not a joke. Like I spend an hour a week in my company Once we got to a certain point, I don't spend more than an hour a week in my company. Now that's pretty passive. That's not bad, right? To do 100 deals in my market. So yes, it's active until you treat it like a business and you become a CEO and not a hustler. If you're just going to hustle and do one deal here, one deal there, kind of like figure it out each one as you go, it's 100% active. You're going to be just like you were doing, Patrick. You're going to bust your butt, right? Every company's like that, right? Apple, when they were in the garage, I'm sure they were busting their butt. But at some point, the company takes on a little bit of a life of its own. You have people, you're not doing everything day to day anymore. So if you ask me about day-to-day operations, granular in my company, I can't even answer the question anymore because I'm not granularly in the day-to-day, right? I'm managing the team. I'm going into the high-level meetings to talk about strategy and vision. But we're doing 100 deals and I'm not spending a lot of time. That's pretty passive. Now, it doesn't generate appreciation. I get that. I acknowledge that. But it is passive.
And it's a compelling concept. But again, my take was that, man, I couldn't I had the compounding interest. I had to keep that company running and it was cash flowing. And what if the market tanked and I couldn't find the deals? What if I couldn't churn and burn anymore? And so what are the risks associated with it? And I think my way out was not to build a company so big that I had to continue to churn and burn. My way out was to trade up to larger assets, which had the economy of scale, 80 plus units, on-site management, that the time began to shrink to manage the portfolios to where it was less time and worth the compounding interest, the appreciation and the debt pay down. So I went the other way. Let's not triple down on flipping. Let's go to larger investments, apartment buildings. But let's talk about the risks, right? Because nothing's without the risks. And when passive investors think about getting involved, there's a lot of things, right? There's some questions in here that are being asked about what about markets, and the prices are high right now, and does it work? And one of the things that continuously comes up in conversations is asset protection. A lot of investors are getting involved in these deals themselves. They kind of get glamorized by some, as you were saying, HGTV show. And they're like, I want to be this next person. Then they go buy something in their own name. They don't know what they're doing. Then they get a loan in their own name, and then they totally expose themselves. They cross-collateralize. There's a lot of things we can talk about when it related to the risk of any investment. Let's dig in a little bit about how you do this in a smart way and protect yourself. I think education and then protect yourself. And maybe Sensei and then Jennifer could jump in there.
Sure. It depends on which model you're going to go into. Are you going to be wholesaling? You're going to be fixing and flipping and do purchase options? You're going to pick up apartments in a syndication? Or are you going to hold your own rental? I mean, there's a lot of different areas, right? But I think the bare basics is never to do anything in your own name. Don't act as a sole proprietor, for one. Number one. Then number two, you want to structure an entity, right? And with that entity, you want to add layers to it. Don't go to legal doom and get one of their templates because it's going to have a bunch of bullet holes in there. You want something that's custom tailored to you and your business. And if you're purchasing properties, especially for the long term, I like to move them over into a land trust. I use land trust for the past 20 something years, and that way it conceals your identity from public knowledge. It's not a true form of asset protection. It's more smoke and mirrors. But if I can make my plaintiff work harder to find out who I am and rack up their bill, why not? So with that, I'll use land trust. And then, of course, you mitigate risk by buying right, cutting costs, buying with equity in it, being able to, for me as a flipper, maybe you've got, like, for instance, us, instead of running over to Home Depot, our Home Depot is our own warehouse because we get granite from China and other places and we store it and it's ready to go. Cutting down risk is another way, is to be able to do what Mike said. Maybe you're that investor that's managing 25 rental properties and you're trying to do fix and flips. Yeah, that's labor intensive. But for me, it's a business, and my business is that I have a team that's behind me, and my team is making a lot of executive decisions in order to move forward. There's no way in the heck I can ever do 15,000 flips on my own. There's no way, so I treat my company like a business. Think of Home Depot. I mean, the guy was probably selling hammers and screwdrivers at one point, and now he's all over the place. You think, he's out there making every single decision? Absolutely not. So if you truly want to build cash and convey that over into wealth, then you got to start getting away from the hobby and start building businesses and portfolios.
Love that.
Yeah. Awesome, Sensei. Very well explained.
Thank you.
This is my favorite part, risk, managing risk. So I break it down in 3 sections. The first one is the legal side and the acquisition. As Sensei said, you need to work with an attorney depending where you are, because you have different things to protect. But how you acquire these properties, it depends on your situation. I don't acquire under my name. There are multiple ways to do so. It depends on your strategy. And there are many ways: land trusts, LLCs, partnership. That's an entire world. Then I divide the second bucket on underwriting or the due diligence. You have to buy right from the start. You cannot buy in speculations. You have to buy in what I call power pricing, always assuming what is the intrinsic value today, not in how much money I can make in the future, especially during these uncertain times. So buying right from the start give you a gap check that allows you to adjust to risk, right? I'm not going to buy a multifamily or a single family home based on the future rent. I'm going to buy it in the rent as per today at the discount that they serve today. And I do acquire based on that in every type of deal, assuming risk. To Sensei's point, also, if I'm operating that as a flip, as a buy and hold, there are different factors from acquiring materials. Like if you were getting supplied from China, for example, and now there was impacts on the tariff, that's something you want to consider in your acquisition too, right? There's many variables during the operation. This is where the things can go different sideways. So this is why you have to be buying right from the start. And then the third bucket, it's getting rid of the asset. I'm always looking at, if I'm going to get rid of this asset, what are the exit strategies that will continue to make money? And no matter what, when I sell this through paper, through the property itself with cash, do I have an exit that ensures that I'm not going to lose my principal and my acquisition was well done? That's how I look at risk.
Yeah, Jennifer, I tell everybody, you should always know how to get out of it before you get into it.
Correct.
If you don't know that first, then you're going to end up getting, an arrow right in the assets.
Fundamental.
Yeah, I know that there's anywhere from in 2020, there was 250,000 properties flipped in the country. In 2023, there was over 300,000 in 2020. So they're going up. And how many of those are successful? How many of those were not successful? You guys have any ideas? You have lots of students. You guys have big networks.
Yeah, I think since COVID, there's been, COVID prices all went up. And so it was super easy for a while. For a couple of years, you could just fall backward into a profit. And then you get to a point like 2022, 2020, going into 2023, things started leveling off and even dropping a little bit in some markets. And I know folks that I'm friendly with and have known for a while that are better house flippers than me. They're just really great, and they struggled. Some of them really got hit hard, and things changed overnight. You see, the biggest problem that people make, even smart guys and gals who are doing this, is it's very easy to get lulled to sleep thinking that the market you're in is the market you'll always be in and acting that way, because the market's always moving, right? And so it's a football analogy, but I like to say you really, when you're investing, like flipping and wholesaling, that kind of thing, maybe more so than buy and hold, you have to, your target is where the house will be in 6 months, not where it is today or a year from now, depending on how big your project is. And so you sort of have to, like the football analogy is like, you don't throw where the receiver is, you throw where he's going to be, right? So you have to sort of take that into account. And I think the reason why most investors, like you said, over 300,000 flips, why probably a lot of those went sideways, it's because it's a lot of people thinking they can just figure it out somehow intuitively on their own. And they're not seeking the help of a mentor or a coach or plugged into some network. It doesn't have to be paid or super expensive, but plug into a network of people where there's a collective learning going on, or collective knowledge, right? Like a hive mind mentality. Because I did it. I was guilty of this. I thought YouTube and just grit would get me everywhere I wanted to go in life, right? And it doesn't, because it's not curated on YouTube, right? It's just good and bad is all in there equally. So I think people try to do it on their own because they're being a little bit cheap. Really, right? And then they make mistakes and they lose money, and then they go, well, this doesn't work, right? I'll be the first one to admit, my first flip, I really didn't have any help. And if we would have lost money, my wife and I, like my wife grew up poor, and I grew up sort of like middle class poor, right? If we would have lost money on that first one, it would have been lights out, overdone, and I would not be on this call because we wouldn't have done it. We got kind of lucky. We made money and we kept going, but then I was smart enough to know I don't know everything, and I was hitting a sort of this glass ceiling. Like I'm doing, 4 flips a year and I'm running around like crazy. I can't do more than this, right? It's like I had to unlock knowledge that wasn't intuitive. It just wasn't in me to know it without help. So I plugged into some folks that were much more advanced than I was, doing a much better job of running their business than I was. And the real point of it was, Sensei made the point at the end of when he was talking, but it's huge and you have to hear this, guys. If you run your business like a lemonade stand at the end of your driveway, bad things will happen to you, right? You have to eventually run it like a business and start running it like a CEO or the leader of a business, not as the side hustle that you just sort of do halfway and you don't really spend a lot of time. This is big bucks we're talking about here, right? Houses aren't cheap. Forget apartment buildings and commercial, right? Houses alone are not cheap. So if you're not going to take this seriously, it's not if you'll get burned and lose money, it's just when, and it will happen eventually.
I love that. I can resonate with that as well. When I started as an engineering robotics engineer, I was like, oh, I can figure that out. I'm good at that. I can also be a real estate investor. And I downloaded a bunch of books, listened to audiobooks, and downloaded some educational webinars. The next thing I knew, I was like buying a house. And yeah, it took me a little bit of time to get humbled and learn to find my tribe. We talk a lot about that on these webinars, is go get out there, find people that are doing and being the things that you want to do so you can learn from them. And the whole purpose of this webinar is to help people along to skip those missteps. Yep. So we're getting closer to the end here. We talked a little bit there's a lot of questions about market. And where do you think we are today? And how would you, where do you think we're headed right now? In terms of good times for residential? Because people look back, everybody, in our age remembers the subprime mortgage collapse, right? And I was in real estate development at that time and I lost everything. And residential, right? Right now, commercial's in a tough spot. Commercial's having a tough time, right? Residential's not getting hit as hard. So where are we at today? Looking forward, we got this new administration. He's a real estate investor himself. Do you think things are going to be looking more favorable? Interest rates have kind of leveled off. Why don't you guys give me your kind of thoughts of the future? And after that, we'll get towards wrapping up.
I think every market is phenomenal. Honestly, if you can't make money in every market, you shouldn't be in real estate at all. You have to act like a Navy SEAL when it comes to real estate markets. Not a Marine that's on the front line as a bullet sponge. Okay, bullet sponge, those guys get hurt, they die, they wither away, and they leave us for trekking on forward. I've been through, since 95, I've been through, a couple different recessions, a great recession and, inflation. All you do is you got to step back, go what Mike said, get consultation, start making some pivots and keep profiting. I don't care if the interest, I do care, but if the interest rates are at 8%, it doesn't stop you from investing. There's so many other ways to be able to invest. Even if the interest rates were down low back like in 2000, and what was it, 22 or 23, where they're in the 2 percentile. How many of you sitting out there right now were sitting on your hands during that time, still doing nothing? It's a mindset. It's not going to University of YouTube. It's about learning what the professionals do and how do you pivot alongside of them and shadow them to be profitable no matter what market you're in. So in today's market, okay, we're short on inventory and we've got high interest rates. But you know what we have? Distressed people and distressed properties. And that means I'm always going to be profitable.
Yeah, I like that you said that, Sensei. I felt like I was going to be the only one saying it, but I agree. The market is not good or bad. It's always fine. It's always great, right? It just depends on how you react to it. You're right. If you wait for the right timing to get into real estate investing, residential, since we're talking about that, you'll never get in. There'll always be a reason to wait a little longer, right? Like I haven't been in it since 95. I started in 2008, but we kind of know what happened right then, right? When I got in. Turns out
the best time.
That was a great time to get in. It was
It
a
was a
great
great
time,
time.
right? Everyone was running out of the burning building, and I was stumbling in, not realizing the burning was happening.
Right.
And it was just a really great time to get in. So, and then things, there's always this like buyer seller, somewhere in the middle. It's all good. When people ask me how's real estate, and they ask me all the time, I always say it's fantastic. It's great. The market is not out to get you. The market is not a monster waiting to destroy your business. The market is agnostic. It doesn't try to hurt you. It just is what it is. And so if you know where the market is, you have to adjust to his point, to Sensei's point. You have to adjust like a Navy SEAL. You have to figure out what's going on, adapt, and go in. It's always a good time to be in real estate, unless you think the market today is going to be the market in 5 years, is going to be the market in 10 years, and you just keep running the same playbook, no matter what the market does. Yes, you'll get crushed, and you'll think that you were in the wrong market, and you shouldn't have listened to Mike and everybody on the panel, right? Because they just led you astray. You lost all your money because the market shifted. No, the market shifted, and you didn't follow it, right? Like, Who Moved My Cheese? You guys know that book, Who Moved My Cheese?
Yeah.
Like, that's it. You just have to go where the opportunities are, and even if you're just a wholesaler and you say, I'm going to wholesale, I'm just going to wholesale, I don't care what happens, right? That's okay. But it's a different conversation with the sellers and the buyers in different markets, right? So you just adjust the way that you run your plays. You don't keep running out the same plays no matter what happens. It's always a good time to be in real estate. Always.
That's right. So the
Amen.
people, I know Jennifer is super, super excited right here, right?
Sensei, you know me. I mean, as an engineer, like data, markets, that's me. I was in the same room as Patrick, being an engineer. Here's something really important to understand. Yes, people might say we're heading to stagnation. Yes, the indicators of days on markets are increasing. We have problems with affordability. We have problems with interest rate. People, if you see yourself as a real estate investor, you're going to go with the wave. If you see yourself as a real estate problem solver, you're going to be able to adapt and pivot as quick as you can. What does it really mean in regards to the market? I am buying all the time, because when everyone is flying, I'm looking at a project with a completely different mindset. How am I going to buy these for a discount property? How am I going to get that discount? How am I going to operate, and how am I going to exit as when the market is in the future, whether it drop 30% or 20%, I'm going to make money in this property. And that's how I look at it. So I don't care about where the market is. I'm always looking at the indicators, the price points. Where are people buying? There's macro markets, there's micro markets. I'm always looking at what's happening in that area to be able to pivot and look at it with a different perspective. Because what I'm going to tell you is that the regular recipe, buy at a 30% discount and flip the property, that doesn't work sometimes. And if that's the only thing that you're using, definitely you need to get with mentors to really help you understand how to get creative and pivot quickly.
I love it. Sensei, did you already respond to that one?
I think I kicked it off, but if you want me to go
Okay,
again,
great.
I can.
Great. No, we're good. I just want to make sure I didn't leave you out, because that was
I
at
appreciate
this
it.
point, I'd like to go ahead and pivot to allowing our panelists here to tell you what products or services or coaching or investments, how they can find you. We're right at that 45-minute mark after the hour. So we'll go Sensei, Jennifer, Mike, and we'll bring up that slide here. We did have a slide. Let me see if I can find it. We'll get it up here in a second. Make sure to verbalize how they can get a hold of you, and drop it in the chat as well. So we have a lot of people, more so people watching the replay. So make sure that you get it out there in all three ways. Okay, go ahead.
Yeah.
All right, Jennifer.
Awesome. I love dancing. That's one of my things. But what kind of services do I offer?
Wait a minute. Can you show us real quick?
Oh, salsa
Can you show us a
dancing.
little bit?
Oh, the entire studio is back here. So, I do teach how to raise capital, but more than that, how to become a stewardship of money. And that allows you to acquire different projects in real estate, not only in the residential side. I just love people to go and jump and do their first step in real estate. So I do help a lot of women, and especially busy professionals and entrepreneurs looking to build their wealth because I also bring the tax optimization when you are a busy professional. They can get hold of me at jenmaldonado.com. I put it in the chat too, or at YouTube at jenmaldonado.com.
Guys, we got a lot of questions here. I think we answered a majority of them though, because we wove in so many of them. I'm going to just go top down. I'm going to start cherry picking some. We answered Dale's questions about what's the difference. Samuel asked about ways to passively invest. Mike offered, and as well as I, that there are in fact funds. And that was also John's question. Wholesaling without a big list or sales background. So Joe's asking, how do you get started? If you want to get started in wholesaling and you don't have a background in it, how do you get started? Wholesaling or flipping, call it. What's the best way?
Well, that's pretty easy. First of all, we got to figure out what your budget is, because we want to be able to cut in your budget, not just in finances, but your budget and finances, time, and your threshold in regards to pain, because you're going to be going through a learning phase. It's like going to the gym for the very first time in a couple of years. You look around, it's like, oh man, I got a bunch of cool different machines here. Not sure where I want to start, not sure how to use them all, but you try them out and you're sore as heck for the next couple of weeks, right? Same thing as stepping into any new venture here. But I would definitely get familiar with the top FAQs with wholesaling. You can get that from any website. You can get that from YouTube University. But you're going to want to make the leap. You're going to want to pick up a coach like myself or Mike that helps in these areas, that have been there, done that. Because can you imagine if you needed heart surgery, that you had a choice to go to a heart surgeon that went through medical school and's got his own practice, or someone that was on YouTube University? I wonder who I'm going to choose. You know what I mean? So you're going to need some quality training. Yes, can you try to figure it out on your own? But how much time and money are you going to burn along the way? So turn off the country rap music in your car and start popping in some podcasts about wholesaling. Get familiar with the process and the terms, and get yourself a coach and counsel to start building your business the proper way.
Yeah, I agree. And I'm here again, I'm going to give you a contrarian opinion on wholesaling. It is not the easiest form to get started. It's not. People see it as a stepping stone to get into like flipping and then multifamily, whatever. I totally disagree. I've done both. I've done hundreds and hundreds and hundreds of both kinds of deals. My daughter came to me about 3 years ago and said, I want to get involved in residential real estate investing. I don't want to be a landlord. It's either going to be wholesaling or flipping. And my own daughter, who I love more than anything, and I never want to see get hurt, I directed her toward flipping and not wholesaling, because I truly believe it's the harder path where you're more likely to lose money in the beginning. So I think if you want to be a wholesaler, it's totally fine. But to Sensei's point, get a coach, get a mentor, get some help, get some guidance. Don't go into it blind. And if anybody wants to know why I think it's more dangerous, I'm happy to talk about it, but I know we're limited time. Just know that it is, and I'm not wrong, and get a help. Don't do it.
I'm just going to add a layer to that, Mike. I agree and I disagree in some areas. Look, any business is difficult. I don't know of any business you can just walk in and open up a door and boom, it's easy. Wholesaling is difficult, but it is the least risky when it comes to having to borrow money. You don't have to do that. You don't have to put a whole lot of money into it. You got to put money into your marketing, and wholesaling is all about building lists. That's what it is. It's a list building business. However, the best fix and flippers I know and others know how to wholesale, because we procure our own deals. We don't have to rely on a wholesaler. So we cut out someone to be able to increase that equity, which helps us on the downside. And always helps us on the upside.
Respectfully disagree. I think wholesaling is more risky. That's just my opinion. And here's why. In a nutshell, I'll tell you why.
Yeah.
Okay? I mean, okay, at scale, it's more risky. Okay, maybe not day one, it's not more risky, but at scale, here's why. As a wholesaler, I would put out $30,000, $40,000 in marketing, right? Costs. That goes out into the ether. I may or may not get a deal that month, right? I usually do because I know what I'm doing. But if I don't get a deal, that $30,000 is gone. Okay. Now, consequently, I'm going to buy a house to flip. I borrow money from somebody, a bank or somebody, to buy that house. That house immediately has a value that is more than what I paid if I did it even remotely right. So that money is protected day one. As I work on that house, I'm increasing its value. The house is theoretically never worth less than the money I owe, right? Theoretically. Now, again, transpose that onto wholesaler, which again, I did at scale, and I did have a month here and there where I spent $30,000-$40,000 and didn't get a deal. That money's just gone. There's no asset that I can pull that out of, right? And so at scale, I think it can be more risky. And that's why, if you do it right. Now, listen, if you're a terrible estimator of values, buying houses can get tricky, right? Because you're going to lose money because you would totally muff the ARV. But I think there's a lot of unsecured money going out into the ether as a wholesaler, and you don't have that so much necessarily as a house flipper, right? If you're procuring your own deals, like you said, and you're spending that marketing anyway, sure, it can happen, right? But I know a lot of flippers that are making a good living.
I love the conflicts, guys, but we got to keep going. I apologize. This is supposed to be a laser round of Q&A here because we're already at the hour. And so we're supposed to be already, so sorry about that. We still have like 40 questions to go though, right? We got to make them. There's a lot in here that are kind of unrelated to the topics, but I mean, like right now, is it better to be to be a flipper or wholesaler or buy of existing properties? These are all existing properties strategies, right? Versus ground up development. What's better right now today?
Jennifer, you go.
I don't think there's a better answer. It depends on your skills. It depends what you want to do. But for sure, what is risky is just jumping to do it right now without knowing what you're doing. That's as simple as that. So you have to work with someone like Sensei if you're flipping or wholesaling, or with Mike too. I don't do flips. I prefer to play the paper world and syndication. But if I have to do flips, definitely it's not my cup of tea. I'm terrible at it. Wholesaling, oh my God, I can wholesale paper and do deals that you guys cannot imagine. So you have to self-evaluate yourself and figure out what are your skills, where are you standing, and what do you already know? Whether it's today, tomorrow, when the market is bad or the market is good, it's about how you are going to address the problems and what do you have to solve those problems. So if you ask me, it's up to you.
So a bunch of questions in here about vetting residential deals, both about the deals, what are the red flags in a deal, and as well as there's questions in here about the sponsor. So maybe we can get some comments on if you're looking at investing in a deal or you're looking at investing in somebody that's looking for capital for a deal, because that's how you're essentially passive, right? In some of these wholesaling, how do you guys conduct your due diligence on these, on these types of investments?
Mike, I'll let you take it. You're the lender.
Okay. So I try to use the MLS. The MLS is just the Bible, right? You have to get good numbers. Everything starts with that end value. What could this house be worth in the future after it's renovated? And I think I just had somebody apply for a loan, and they gave me comps that really didn't support his valuation, right? He said the house would be worth X. His comps, 2 of the 3 comps he gave me were less than what he said, right? Because he went to a realtor and said, I need comps for this house. And the realtor pulled comps the way realtors do. It's just like a smattering of like foreclosures and houses that weren't fully renovated and houses that were. So I had to have a conversation with him. The first thing is, when you're evaluating houses as an investor, you're going to flip the house. You really should only compare yourself to houses that have been fully renovated, right? Whatever that looks like for that number, similar bedrooms and bathroom square footage, all that. But don't compare yourself to a foreclosure or something that was renovated last in the 90s, right? When Sensei started investing, we don't want something that was renovated back then. So you really have to compare apples to apples, and oftentimes people mess up that first number, what we call the ARV, after repair value. They mess up that number for whatever reason. A realtor gave them the wrong information, whatever it is. And everything they do after that, right? The math is wrong because the first number was wrong. And so you have to get that first number right. That's key. If you don't, everything else will be wrong. No matter how good you are at estimating renovations and all that stuff, everything will not work if you don't get the top of that pyramid right.
So I want to hear talking about the volatility of these residential real estate strategies versus the stock market and crypto. Somebody asked about crypto in here. So, I mean, that's a wide range. We talk a lot about non-correlated investments and investments that don't ride the same market fundamentals. And that's what you're talking about here. You're talking about real estate that has ridden waves, and you're talking about the stock market occasionally, but not statistically, they'll correlate. And crypto's all over the place, man. That's super sentiment driven. So Maybe you guys have something to say. I think that investments, aside from crypto, but investments in other things. I'm not a big crypto guy. I have some crypto. I'm not proud of it. I mean, doing great. I'm like killing it actually, but I'm not proud of it because it's kind of just a flyer. But I think lots of pillars and different non-correlated investments is what we always talk about, so that not any one piece of your wealth is hanging in the clinch of one market swing, or else you end up like I was back in 2009 and 10, lost everything in residential real estate. So that's my take. I'll let you guys respond.
Yeah, I so look, think about this guy this way. These guys, if I were to look at real estate and stocks, and those two are always going head to head, right? And I invest in both, but I have more faith in my real estate than I do in my stocks. And we all know that stocks go like this, right? They go like this, but they continually to go up. And real estate, you can see it coming, whether it's going to rise or fall. It's a very much slower market, and you can foresee. Think of it this way. If I walk into a bank today, you pick the bank, Chase, Wells Fargo, and I say, hey, I got a great stock tip. I like to go to the stock tip department and borrow some money. They're going to laugh at me. But if I want to go borrow money on real estate, whether it's a depression, a recession, or the roaring 20s, they're always going to have a department. What does that say? That says that the financiers are going to back real estate way before they're going to back stocks. And whether it's a good market or a down market, the money is still there because they have a tangible asset versus a stock that can be here today and poof, vanish tomorrow.
Any other comments on that one?
100% agree. I think if you look at the real estate market over time, in a macro sense, there's a lot of volatility, right? I'm sorry, in a micro sense, but in a macro sense, it's sort of like a 45-degree angle up, right? So if you're buying for long-term appreciation and debt pay down, to Sensei's point, right? The banks totally believe in it, and so do I. In the short term, it can be volatile, right? But ultimately, it all ends up going up, and so that's why you have to be very sharp if you're going to do short-term, strategies. You have to be very sharp and plug into a network and sort of like know your market and all that stuff. But real estate's great long-term since we've all been around, right? It's great. It's gonna be great.
There's a question in here about why is commercial real estate getting hit harder than residential real estate. I mean, that's a little bit off topic, but commercial real estate, yeah, post-COVID is what they listed, but the interest rates are one piece, but skyrocketing insurance, inflating materials, and payroll costs, and it was the eviction moratorium that crippled a lot of large apartment buildings, and they've had a really difficult time recovering. So also in that world, you have a bunch of bridge loans that are like 3 or 4 years. Yeah, that record high bridge loans that are now coming due. While you see the deflating, and Sensei made a comment earlier. I don't know if I agree. Real estate goes like this, and you can see it coming. I'll tell you what, man. In 2008, I didn't see it coming. I don't think anybody saw that coming, right? The residential real estate subprime mortgage collapse. I think you can see trends. I agree that as you hold a property, micro trends you can see coming. And one of the good things about leases is that if you hold long term, they're locked in for 12 months, and you can kind of plan if you see things shifting. But I think just like the stock market, man, I think real estate could sometimes make a stepwise jump. And so I just from my own experience, since we're all debating here on the panel.
I got to jump in here just because I'm argumentative. I agree with Sensei. I think it is predictable and slow moving, but if you pan out and look at real estate, about every 10 to 15 years, there is a real correction, right? And so while I didn't know it was coming, you didn't know it was coming, nobody knew it was coming, kind of we knew something was coming eventually because that was just the pattern, right? It just depends how far back you scale back on what you're looking at, right?
Agreed.
Real estate has predictably done this every 10 to 15 years, right? Which means technically something's coming pretty soon, right? So we know that, right? We just don't know when exactly. So you're both right, but I want to defend his point because I think he was actually had a good point.
11 out of the last Fed rate hikes ended in a bust. So, and we're right now in a tariff war, in addition to spiraling spending, and the world's biggest economy is betting against the dollar. So let's see how it goes, right? I think it's time to invest in non-correlated recession resilient investments. That's what we're talking about here, and residential real estate's one of them. And I think that this was a really great panel. I think we're pretty much the end. I just read through them again. I think we kind of grouped. If we missed it, if we missed your question, that's okay. Why? Because you just got everybody's contact information here. And so you can reach out to them directly and you can continue the discussion offline. At this point, we've kept them way over time. Don't forget, 2 weeks from today, we're going to be talking about private credit with businesses, a completely different, non-correlated investment to add to your portfolio. We're going to go deep into the risks, how it works, and how to win from it from some people that have been doing it for decades. Really excited about it. Sensei, Jennifer, Mike, this was an awesome panel today. A lot of really great insights, a lot of good nuggets. Appreciate everybody that hung in there with us to like the bitter end here. And if you're watching the replays will go out in just a couple days. So we'll give these out to everybody. Make sure to reach out and I'll see you in 2 weeks. Thanks so much.
Appreciate it, guys.
Appreciate it. Had fun.